Your stock portfolio just took a hit from something you probably didn't even notice. While everyone's focused on the bombs falling in Iran, something far more critical happened to your retirement account. And almost nobody's talking about it. Here's the reality. Iran or any geopolitical conflict is always the attention-grabbing story. It's the main headline, it's the dramatic footage, it's the endless scroll material, but the actual story is what's happening behind the scenes, quietly, systematically, and predictably, while everyone's distracted by explosions and constant news updates. And if you don't understand what's happening right now, you'll repeat the same mistake that cost everyday investors their fortunes in every previous crisis. So today, I'm going to walk you through the actual playbook. I'm going to show you the data and explain 3 investment strategies you need to understand. First, oil and why it's actually a trap that hurts most people. Second, gold and why it tends to preserve value longer than oil when fear takes over. Third, defense stocks where institutional money quietly moves. Plus, the one question that really matters, is it too early or is it too late? The real advantage in investing comes from being able to recognize opportunities before everyone else catches on. If you want exclusive weekly content showing the exact stocks I'm buying and want to develop the skills to trade like a top 1% investor, you'll find that in my private group, which is linked in the pinned comment. Because right now with Iran, we're seeing the same Wall Street patterns repeat again. Every crisis splits investors into 2 distinct groups, those who understand the system and those who simply react to headlines. And reacting to headlines is exactly how you become the exit liquidity. Let me show you what's actually happening. Let's start with the part you're not supposed to notice, money printing disguised differently. The Federal Reserve started increasing liquidity again. It's intensified recently and will likely continue because the system can't handle the alternative. The clever part is this, they don't call it money printing anymore. They don't even use the term QE anymore because QE became a problematic word. So they rebrand it, they dress it up, they make it sound technical and boring, so you ignore it. They use terms like reserve management purchases or liquidity operations or temporary market stabilization, whatever the label is this quarter. But the actual function stays identical. Create new money. Use it to absorb government debt. Use it to support banks. Keep the financial system functioning. Keep the lights on. Keep asset prices from falling too rapidly. And if you're wondering why this matters, here's the straightforward truth. Everything depends on how much money exists in the financial system. More money circulating around means higher nominal asset prices. Less money means the tide recedes and you discover who's been swimming without clothes. This is why the actual story of most crises isn't the crisis itself, it's the policy response. Because when the Federal Reserve expands liquidity, 3 things happen almost without exception. And they happen in such a predictable order, it's almost embarrassing. First, it pushes interest rates down, or at minimum, it stops them from rising too much. That creates cheaper borrowing for the government, cheaper borrowing for companies, and cheaper borrowing for regular people. Car loans, home mortgages, credit cards, everything. Second, it reduces the currency's value over time. Print more dollars, and each dollar buys less. That's not opinion. That's basic math. Third, it increases asset prices. That fresh money doesn't stay still. It goes somewhere. It searches for yield. It runs ahead of inflation. It moves away from cash into things that are limited, productive, or just seem safer than paper money. So who benefits? People who own assets. Who gets hurt? People who hold cash. People whose wealth is just a number in a bank account. People whose net worth comes from wages, not ownership. That's why your retirement account gets damaged in ways you don't perceive. Not with a sudden crash, but with a gradual erosion in what your money buys. With rising inflation, with currency devaluation, with the price of living increasing faster than your income. And the harsh truth is, the typical investor believes the danger is the headline. They think the danger is war as an abstract concept. No, the real danger is what the system does in reaction to war. More spending, more budget deficits, more refinancing, more liquidity, more market distortion. So why are they doing it? Because the government is carrying a debt load so enormous it can't afford regular interest rates for regular time periods anymore. Here's the trap. Historically, governments borrowed long-term 10 years, 30 years, locking in rates that shift gradually. But increasingly, much of the borrowing becomes shorter term. They refinance constantly. That means a massive amount of debt must be rolled over and over again at whatever the current rate happens to be. So picture this. The Fed increases rates aggressively and keeps them elevated. What occurs? The interest expense on refinancing balloons. The budget gets destroyed and the system starts collapsing internally. That's the debt spiral. And once you recognize it, you can't ignore it. Which means this. In almost any major disruption, the easiest path becomes some form of liquidity expansion. Now let's connect this back to Iran, because this crisis is the perfect opportunity. Not as a political statement, not as a moral question. I'm not here to tell you who's right or wrong. I'm here to explain how money flows. You've got military operations, you've got retaliation possibilities, you've got the Strait of Hormuz. The most critical choke point most people never think about until it's trending on social media. Millions of barrels of oil travel through that passage. A significant share of seaborne oil moves through it. So the instant fear spreads, oil reacts immediately, it jumps quickly, it's noticeable, it's straightforward. It's simple to understand, which is precisely why everyday investors get pulled in, because they wake up, notice oil climbing, and think, I need to get into oil stocks. And that's exactly how you become the exit liquidity. Here's what most people don't understand. Oil goes up first, and oil frequently comes down first, too. Oil has something known as a war premium. It's not just supply and basic demand. It's fear, it's uncertainty. It's what-if scenarios, it's market positioning, it's traders purchasing protection, and momentum funds following the move. But once the actual fighting happens and the world recognizes the sky isn't about to fall in the next couple of days, that premium can collapse dramatically. Historical example, the 1991 Gulf War. Oil spikes strongly leading into the war. And then when the U.S.-led operation launched, oil dropped sharply, a massive single-day decline because the unknown became known. The market hates uncertainty, yet it also hates being mistaken. And when everyone is in the identical panic trade, the reversal is severe. So my oil strategy is straightforward. If you're early before the masses, oil can work as a trade, but it's not really investing. It's not, I'm going to keep this for safety. It's a volatility play. And once the trade becomes obvious, once it's on every news outlet, once everyone's discussing it at the gym, once your cousin who's never bought a stock messages you, should I buy oil? The simple profits are usually already taken. Oil is where most people buy panic, then give their profits back when the reversal happens. Now, does that mean never buy energy stocks? No, because there's a distinction between oil producers whose earnings swing with the crude price and the support structure and services sector that gets paid regardless of the economic cycle. Oil service firms, equipment makers, maintenance, field work, many of these have different characteristics. They can gain from longer investment cycles, from ongoing production requirements, from supply shortages, from replacement need, but that has less to do with Iran and the news and more to do with where investment spending cycles are moving and where big institutional money is placing bets. And this is the part everyday investors constantly overlook. It's not just what you buy, it's when you exit. Most people buy and then they emotionally manage the exit. Wall Street doesn't work that way. Professionals arrange their exits before they even enter. They have rules, they know when they're wrong, they know the price level, they know their time frame. They know what must occur for them to be incorrect. Everyday investors do the reverse. They buy when it feels urgent and they exit when it feels frightening, which is why they end up buying at the top and selling at the bottom, even if they pick solid companies. So if you're paying attention to Iran and thinking, I want oil exposure, the better question is, are you behind on the panic move? And do you actually have an exit strategy? Because if you don't understand where you'll get out, you're not actually trading, you're volunteering. Now, let's talk about the second strategy, defense stocks. And yes, some people don't approve of the idea of owning defense companies. That's a personal choice. You don't have to own them, but you should still grasp them because the money flows regardless of what you think. And your role as an investor is to follow the money flows. Here's the reality about defense spending. It doesn't operate like a typical business. It's budget determined. It's shaped by geopolitics. It's multi-year. It's long-lasting. And it's filled with steady income that most people tremendously underestimate. The focus is always fresh contract, but the genuine cash flow is what takes place after the agreement is signed. For many defense systems, a substantial portion of total lifetime expense is maintenance and support, upgrades, components, software, staff training, transportation. It's not sell once, it's sell once and then service it for years or decades. So when a firm delivers a system, they're not just sending equipment, they're getting locked into a framework of sustained income. Now, people enjoy discussing backlog in defense like it's an interesting fact. But backlog is important because it means certainty. It means revenue that's already guaranteed. It's among the reasons institutional investors like the industry during uncertain conditions, dependability. And in a world where the government is driven to spend because spending is easier politically than cost cutting, Defense becomes a place where money gets directed. That's why defense can advance even when everything else is unstable. It's less tied to consumer attitudes and more tied to budget movement. But here's the catch. Everyday investors typically find defense stocks after they've already moved upward. They enter after the gains because the gains made the news. Meanwhile, institutions typically get positioned before the news because they understand the movement of budgets, purchasing schedules, and legislative direction. So the actual question isn't whether defense stocks are worthwhile. The actual question is, where are we within the money cycle? Because defense stocks can absolutely become overvalued. They can absolutely slow down. They can absolutely trade sideways for extended periods while valuations catch up. And this is where most people go wrong. They think conflict means buy defense as if it's immediate. But markets are forward thinking. The moment to enter is usually when positioning is low and the story is developing, not when the graph is vertical and the news is screaming. Now, if choosing individual defense companies feels too concentrated, there's an easier option. Broader exposure using an aerospace and defense ETF. That way, you're not putting all your money on one firm or one system. You're getting a range. You're getting spread exposure across major contractors and elements of the supply chain. But even with ETFs, you require the identical element, an exit approach. Because the distinction between professionals and amateurs isn't what they purchase, it's how they manage it. Now, beyond the big names everyone mentions, there's another area most people miss. Subcontractors. The large companies tell the story, but the smaller contractors frequently supply the sensing systems, the processors, the connection, the flight equipment, the unique substances, the pieces that spread across different systems. Sometimes those makers perform stronger because they're not as well known. Sometimes they have more upside to volume. Sometimes they're off the radar until late. Which brings me to the third strategy, gold. Gold is doing exactly what it should. And the reason gold functions differently from oil is straightforward. Oil is a panic jump with a quick collapse risk because it's tied to a particular supply route story that can fix fast. Gold is broader. Gold is the universal hedge. It's insurance against currency destruction, insurance against rising prices, insurance against declining trust, insurance against policy errors, insurance against the gradual support cycle where the government prioritizes liquidity above prudence. So sure, gold can jump during a disruption just like oil. But historically, gold typically keeps elevated rates longer than oil because what happens after matters. The approaches implemented after the disruption matter. And after a disruption, you typically get the exact conditions gold enjoys. More government spending, more budget deficits, more liquidity pumping, reduced real interest rates, more need to steady the markets. Now, I want to give you a system for gold that prevents you from making the standard retail error, which is treating it like a lottery. First guideline, gold isn't a trade, it's insurance. You don't purchase house insurance hoping the home burns down. You buy it for peace of mind. Second guideline, you get insurance before you require it. If you purchase gold only after the world is on fire, you might still benefit yourself, but you're paying too much. You're behind. Third guideline, gold typically keeps value, not just through the disruption, but through what happens after, because that's where the currency deterioration and government approaches surface. So for the majority of people, the question isn't whether I should get gold, it's what portion is appropriate for me. And that depends on comfort with risk, your timeline, what you currently own, and what you're trying to shield against. Some people have none. Some people have a small position. Some people have a bigger stake. But here's something that should make you stop and think. Central banks have been increasing their gold holdings. Read that once more. The establishments that control the money system, the ones with the printing presses, have been moving into hard money. That tells you something about their outlook. It doesn't mean the dollar falls tomorrow. It doesn't mean civilization ends. It means the institutions that understand how money systems work see gold as an essential strategic asset. And if they're doing that while the typical person is told gold is worthless, you should question who's being foolish here. There are also market indicators you can track like physical movement, price gaps between markets, stock levels, how gold moves compared to interest rates and uncertainty. None are perfect signals, but they're components of the picture. And here's why this is relevant. If you grasp the government approaches, you quit being reactive. You quit being the individual who sells everything because the media says to be afraid. You quit being the individual who sits on cash expecting to enter later. As your purchasing power gradually erodes, you quit being the individual who shows up behind on oil, behind on defense, behind on every development, and then wonders why asset building doesn't succeed because it actually works, but differently than individuals assume. So, let me provide my three-step crisis approach. Straightforward, practical, and useful for the next disruption too, because there will always be another one. Step 1, track the new money, not the old money, not the commentary, the fresh money, the available funds, the fresh tools, the balance sheet assistance, the insurance, the programs, the emergency steps, because the money goes someplace and your responsibility is to spot where it's heading, not by guessing, but by watching. Step 2, grasp the pattern. Oil reacts initially and can drop the hardest once the fearful premium decreases. Gold acts as a broader hedge and frequently holds strength longer, particularly if approaches become accommodating. Defense gains from steady budget movement and buying schedules, but your entry point counts because markets value stories first. Step 3, pick whether you want to be early or you want to be accurate. You're either one or the other. If you want to be early, you take on more doubt. If you want to be accurate, you pause for facts and take worse entry points. Most everyday investors do the worst choice. They're behind and doubtful. They enter after gains and still lack belief. So they exit the moment things get uncomfortable. That's how you fail twice. So what should you do right now given the Iran scenario and the bigger system behind it? First, examine your money reserves. If you're sitting on a lot of money, recognize what that implies. Money is a placement. It's not neutral. It's a wager on calm and purchasing strength. If that's intentional for you, fine. But don't accidentally hold huge money reserves because you're frightened and calling it being wise. Second, evaluate your precious metal allocation. If it's 0, ask yourself why. If it's something, ask yourself if it matches what you're trying to hedge. Not what social media says, not what a metals dealer says, what you genuinely require. Third, if you're in oil or oil companies that move with crude prices, have an exit approach, not I'll play it by ear, a real approach. Because oil is a strategy where the crowds get hurt most regularly. Fourth, if you're examining defense, go further than the news stories. The biggest companies are obvious. The smaller suppliers are where much of the value often surfaces. But again, your moment counts, and rules are important. And fifth, the most important one, stop consuming constant news. I mean it. The news is created to grab your feelings. It's built to make you reactive, and reactive people get destroyed. If something genuinely counts, you'll know. You can't dodge facts. But you can skip 14 hours of panic content that transforms your investments into an emotional weight. Don't react to the disruption. Predict the government response to the disruption. The disruption is sound. The approach is the substance. And the approach is nearly always some type of increased spending, additional debt, more refinancing, and quietly raising liquid funds when things get stressed. Once you grasp that, you quit being stunned. You quit being afraid. You begin playing the genuine game if you want to create actual prosperity and prove yourself through continuing education. Inside, you'll receive exclusive weekly material showing the specific companies I'm buying and the way to build long-term riches. It's in the pinned comment. And if this information assisted, pass it to a friend